Hello, Assalamualaikum sir. We are from Group 4 and we will present our findings about front-end Berhad. My name is Nonna Zatul Akma and my matrix number is UDE210030. I will start with the situation that we have created on the report based on their policy on property, plant and equipment, inventory and trade receivable. For the first one is property, plant and equipment. On the 1st January 2014, Frontcan Berhad bought 6 new computers for 15,000 ringgit in cash. The computers is used for the production of the codes. The company planned to use the computers for 5 years and expect the residual value after 5 years to be 3,000 ringgit. At the end of the year 2019, the computer was sold at 5,000 ringgit. With the calculation that we have provided, our advice on how to integrate into financial statement is, in the financial statement, Frontcan Corporation Berhad should record the property, plant and equipment for 15,000 ringgit and the accumulated depreciation is for 12,000 ringgit. Why? This is because the computers has been disposed by selling, which means it is no longer a property, plant and equipment, as item that is disposed will be removed. Furthermore, the cash received from the disposal of the computers must be recorded in cash and bank balance in the statement of financial position. According to Note 12 of financial statement, property, plant and equipment, the cost as at 31st December 2019 is for computer is 1,577,966. The accumulated depreciation recorded is RM244,133,456. Now, the cost of the computers must be 1,562,966 and the accumulated depreciation is 244,121,456. This makes the total property, plant and equipment recorded for the year 2019 in the financial statement is 372,132,980. Frontcan Corporation should also record the gains on the disposal of the computers 2,000 ringgit under the statement of profit or loss and other comprehensive income. The depreciation of 12,000 ringgit will be recorded under the other operating expenses, reducing the net income. Now we will move on to the second one, which is inventory. For the situation, Frontcan Berhad purchase and sell a single product and the opening inventories on 1st March 2021 was 600 units at a total cost of 1,800 ringgit. The sale price of the product is 10 ringgit per unit and the following transaction happened during the March 2021. The value of closing inventory of Frontcan is calculated by using FIFO method. Now, we will move on to the transaction happened during March 2021. On 4 March 2021, Frontcan Berhad purchased 1,000 units with total price of 3,000 ringgit. On 8 March 2021, they bought another 500 units with total 1,500 ringgit. On 11 March 2021 and 13 March 2021, Frontcan sold another 1,500 and another 300 units product. On 18 March 2021, they purchased again another 2,400 units that cost 7,200 ringgit. Lastly, on 22 March and 27 March 2021, they sold another 1,000 units and 700 units of product. The expected selling price of the inventory is 35,000 ringgit. And Frontcan needs to spend another 10,500 ringgit for the goods, 500 ringgit for the transportation expense, and 225 ringgit for the advertising expense. Based on the calculation that already given by us, our advice for Frontcan on how to integrate into financial statement is Frontcan should record their inventories by using the net realizable value since the NRV is lower than it costs. The company needs to record the amount of the write-down as the expense in statement profit or loss and other comprehensive income. Now, we will move on to the third one, which is trade receivable. For the situation, Frontcan chose to write off 6,000 ringgit in uncollectible account receivable. Frontcan employs the allowance technique for bad debts, and the allowance for doubtful debt account has a credit balance of 8,300 ringgit. Frontcan later received another 1,000 ringgit from previous written off account receivable. After preparing the calculation, journal entry and all the account related, we advise Frontcan Berhad should shorten the payment terms. Frontcan Berhad might also reduce the payment window by shortening your payment terms. Frontcan Berhad, on the other hand, should base on your payment terms on the industry standard. If the industry standard is net 60 and you are offering the net 30, you can lose your business if the purchase price is higher or your clients are cash flow constrained.
Firstly, let's start with the MFRS 9 that covers financial assets and liability. Financial assets are classified when the asset is held within the business model whose objective is to hold financial assets, to collect contractual cash flows, and asset also needs to have contractual terms of giving rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. For the financial liabilities, most of it is measured at amortized cost except for liabilities that are fair valued through profit or loss. Liability that are arisen when assets transferred does not qualify for derecognition. Through inventories, we use the MFRS 102 to classify it. The commonly classified inventories are merchandise, production supplies, materials, work in progress, and finished goods. The inventories are also have to be useful for financial statement users. Next, the MFRS 116 is for property, plant, and equipment. The PPE shall be recognized as an asset if it is bring economic benefits and the cost can be measured reliably. Next, the MFRS 132 helps in presenting the financial instruments. Financial instruments such as financial assets, financial liabilities, or equity instruments are under the substance of the contractual arrangement based on the definition in MFRS 132. And lastly, based on a report from Frontcan, the allocation of an impairment loss is only measured within the carrying value of the asset. The measurement is as follows on the MFRS 136. That is all for me. I will now pass to the next presenter. Thank you.
A very good morning to Sir Yaksan and everyone. My name is Muhammad Nabil Iqbal bin Abdul Basir and my matrix number is UDE210069. And today I will be talking about, for the part 1, number 3 subsection, the process in finding the policy, performing the asset situation related to property, plant and equipment, inventories and accounts receivable. For trade receivable and account receivable, the group utilizes the simple technique to determine a lifetime estimated credit loss allowance. The group calculates predicted loss rates using past sales payment profiles, including changes in customer payment profiles as a result of the COVID-19 pandemic, and historical credit losses adjusting for qualitative and quantitative, reasonable and supportable forward-looking information. If the expectation differs from the estimate, the carrying value of trade receivables will be affected. Note 17 to the financial statements discloses the carrying amount of trade receivables at the reporting date.
Assalamualaikum and good morning. Today I will present about this all assets have same definition. A resource having economic worth that an individual, business or country processes or controls with the hope of future gain is referred to as an asset. Assets are purchased or developed to raise a company's worth or benefit its operation and are reported on the balance sheet. Whether it's manufacturing equipment or a patient and assets may be looked at as anything that can create cash flow, cut expenditure, or increase sales in the future. An asset is a financial resource for a corporation or access that other person or business do not have. A legal right or other access indicates that economic resource can be utilized at the discretion of a corporation and their use can be prohibited or regulated by the owner. A corporation must have a right to an assets as of the date of the financial statement for it to be present. An economic resource is anything that is limited and has the power to generate an economic gain by increasing or reducing cash inflow or outflow. All assets do not have the same definition. This is because assets have many different types of meanings. Firstly, current assets. Current assets are short-term economic resource that will be converted to cash within a year. Cash and cash equivalents, account receivable, inventories, and different prepaid costs are all example of current assets. While cash is simple to value, accountant must evaluate the recoverability of inventories and account receivable regularly. It will become impaired if there is evidence that account receivable may be uncollectible. Companies may also write off inventory if it's become outdated. The second is fixed assets. Plants, equipment, and building are example of long-term resource. Depreciation is a recurring charge that may or may not reflect the loss of earning capacity for fixed asset. It is used to account for the aging of fixed assets. Depreciation can be taken in two ways. According to GAAP, the straight line technique posits that the value of fixed assets depreciation in proportion to its useful, whereas the accelerate method assumes that the asset depreciates more rapidly in the yearly year of usage. Next is financial assets. Financial asset is investment in other institution, asset and securities. Stock, government and corporate bonds, preferred equity and other hybrid instruments are examples of financial assets. The value of financial assets is determined by how investment and classify and the motivation behind it. Lastly, intangible assets. Intangible assets are financial resources that do not have a physical location. Patent, trademark, copyright, and goodwill are among them. Intangible assets are treated differently depending on their kind, and they might be amortized or essential for impairment each year. For the conclusion, as previously said, assets are products or resources that provide more revenue for a corporation. As a result, business must have a robust assets basis. A corporation that has a good assets position is seen to be healthy. It draws a large number of investors by projecting a positive image. Financial advisor must also seek to strike the correct balance between asset and obligation on a regular basis. To finance liabilities, the correct amount of asset is necessary. Companies with large obligation and little assets are vulnerable to financial distress and can suffer greatly. That's all from me. Thank you.
And next is I'm going to talk about part 2, question B. And the question is, can you differentiate between property, plant and equipment? Property, plant and equipment, or PPE, are a company's physical or tangible long-term assets that typically have a life more than 1 year. Examples of property, plant and equipment including buildings, machinery, land, office equipment, furniture and vehicles. Companies list their net PPE on their financial statements. Moreover, property, plant and equipment is the long-term asset or non-current asset section of the balance sheet that reports the tangible long-lived assets that are used in the company's operations. These assets are commonly referred to as the company's fixed assets or plant assets. Property, plant and equipment are the long-term tangible assets that a company owns. They are most often fixed assets. PPE, which includes trucks, machinery, factories, lands, allows a company to conduct and grow its business. Moreover, PPE is depreciated over time and can be sold for its salvage value. When a company purchases PPE, it is known as capital expenditure. Proper management of capital expenditures is crucial to the growth and profitability of a company. So much so that investors analyze how a company manages its PPE to determine if its capital expenditures will aid its success or be drained on its funds. That is all for me. Thank you.
Assalamualaikum and hi. My name is Ahmad Hamdi bin Yasir. My meter's number is UDE210030 and I will help to answer the question, does intangible assets consist in non-current assets? The non-current asset is a long-term asset that provides future economic benefits that are attributable to the asset, yet they are not easily convertible into cash. Thus, they are not liquidated. The same goes for intangible assets. The intangible assets shall be recognized if it is attributable to the future economic benefits and the cost of the asset can be measured reliably. Intangible assets consist of trademarks, patents, copyrights. Thus, making the intangible asset is within the non-current assets. I will now pass to the next presenter.
Now I will answer question number 4, which is how does inventory are recorded in the corporation? The inventory are recorded in the corporation by using the lower of cost and net realizable value and the purchase price and incidental expended in moving the stocks to their current location and condition are calculated using the first in, first out FIFO technique. The estimated selling price is subtract from the project finish expense and the estimated closing cost to arrive at the net realizable value. Now, I will pass to the next presenter. Thank you.
Hello and greeting to Sayyid Azan and everyone. My name is Muhammad Irfan bin Ishaq and my trade number is UDE210030 and I am from Station 1. So now I will present about why do we need first in first out inventory recording system in an corporations. But before it, let me share with you some of the methods that used in recording the inventory. The most popular system used is FIFO, which is first in first out, and LIFO, last in first out. So the highlight for today's presentation is first in first out method. First in first out or FIFO is an accounting method in which assets purchased or obtained first are disposed of first. FIFO assumes that the remaining inventory consists of items purchased last. An alternative to FIFO is LIFO, which is last in first out. Last in first out is an accounting method in which assets purchased or obtained last are disposed of first. Often, in an inflationary market, lower older costs are assigned to the cost of goods sold under the FIFO method, which result in a higher net income than if LIFO were used. Okay, now I will share about how the FIFO method works. So basically, when you order product for a business, you rarely order your entire year's worth of product all in one go. To understand how first in first out inventory cost calculating works, you need to assume that you have 3 big order of inventory every year. Your first batch of inventory includes 1,000 pieces of inventory which cost 4,000 ringgit to produce. The second includes 2,000 pieces of inventory which cost 8,000 ringgit to produce. And the last includes 1,500 pieces which cost around 7,000 to produce. That means that your total inventory throughout the year was 4,500 pieces at 19,000 ringgit Malaysia. So it means that the average cost is 4 ringgit and 22 cents per pieces to produce. Okay, now you assume that you have sold 4,000 of those pieces of inventory in the given year. However, if you look at the data a little closer, you will see that the last batch of inventory was slightly more expensive to produce than the first and two. The first and two batch cost Rm 4 ringgit per pieces to produce, but the last batch cost Rm 4 ringgit and 67 to produce. If you doesn't know exactly which product from which batch was sold throughout the year, how can you correctly inform the government of your price per pieces on your taxes? This is where FIFO come in. This method tells you to report based on the first order of inventory and works toward the most recent. So out of your 4,000 units sold for the year, 1,000 come from the first batch of inventory at Rm 4 ringgit per pieces. 2,000 come from the second batch of inventory also at the same price, which is Rm 4 ringgit per pieces, and 1,000 come from the last batch of inventory at 4 ringgit and 22 cents per pieces. Now you simplify the average cost per pieces with this set of number 4000 pieces at 4 ringgit and 6 cents per pieces. This average inventory cost based on the first in first out method of calculations is what get reported to the standard. That might not be exactly what happened, but it could be that those leftover 500 pieces of inventory were actually from the third batch. But this method allows you to get a calculations to use in situation where it will be impossible to know which batch of inventory was sold. So here are the reasons why the corporation need to use first in first out inventory recording system in their business. FIFO or first in first out is the only method allowed by the Internal Revenue Service (IRS). If your business has international location, for example, FIFO is required by the government on tax reporting. But there are other reasons to use a FIFO that can be a benefit to a business. If your inventory costs are going down as time goes on, FIFO will allow you to claim a highest average cost per pieces on the latest inventory, which can help you save more money on your taxes. Additionally, FIFO does not require as much record keeping as LIFO because it assumes that all the items are gone. With LIFO, it may appear that all the items are kept in the system for a year, which means more record keeping must be done on the lifespan of product. In most businesses, older products are actually sold first due to the way companies train stocking employees to display order in front. So this accounting method typically does reflect reality as closely as possible. FIFO also made it possible to account for change in product cost, while an accounting system like weighted average cost does not. With FIFO, however, each piece of inventory sold is based on the constantly changing price of each batch. It means that once the order batch is also in the system, your COGS is recalculated and your inventory price per pieces changes. This means you get a more accurate reflection of your price per pieces of inventory during an accounting period. FIFO can be used for inventory systems that are periodic. It means that inventory only happens during certain time of the year or perpetual, and it means inventory is taken constantly. In conclusion, first in, first out method is more accurate than some inventory valuation method and less regulated by the IRS than others, which is what makes it such a solid choice of businesses. That's all from me. Thank you for watching.
Hi, my name is Emil Usman Sibir Muhammad Fauzi and my matrix number is UDE210030. So for my question is, does every corporation need to have financial instruments? In my opinion, yes. This is because it is very important to have one. Why? It is because the use of financial instruments can reduce exposures to certain business risks. For example, changes in exchange rates, interest rates, and commodity prices, or a combination of those risks. What is financial instruments? Most types of financial instruments provide efficient flow and transfer of capital all throughout the world's investors. These assets can be cash, a contractual right to deliver or receive cash, or another type of financial instrument, or documents or evidence of one's ownership of an entity. Financial instruments can be real or virtual documents representing a legal agreement involving any kind of monetary value. Equity-based financial instruments represent ownership of an asset. Debt-based financial instruments represent a loan made by an investor to the owner of the asset. The use of financial instruments is to raise capital. Companies issue stocks and bonds, which are sold to investors in exchange for rights to ownership or interest payments and a promise to repay the principal or original amount invested. As for the company we are referring to, which is Franken Corporation Berhad, the major of financial instrument for this company is its individual stocks. Cash instruments can be further classified into equity instruments and debt instruments. Equity instruments refer to instruments which represent ownership of the asset. Types of equity instruments are common shares. Common shares represent partial ownership of the company and provide their holders claims to future streams of income paid out of company profits and commonly referred to as dividends. Next is preferred shares. Preferred shares is a financial instrument which represents an equity interest in a firm and which usually does not allow for voting rights to its owners. Typically, the investor into it is only entitled to receive a fixed contractual amount of dividends, and this make this instrument similar to debt. Preferred shares can also be non-cumulative, redeemable, convertible, participating, and etc. Private equity is when companies are organized as partnerships and private limited companies. Their shares are not traded publicly. The form of equity investments, which is made through private placements, is called private equity. The most important sources of private equity investments came from venture capital funds, private equity funds, and in the form of leveraged buyouts. Investors may invest into foreign shares by purchasing shares directly, purchasing American depository receipts or global depository receipts. Exchange traded funds are passive funds that track specific index. Thus, investor can invest into a specific index representing a country's stock market. Debt instruments represent debt and loan given by a financial investor to the owner of the asset. The types of bonds usually issued in debt capital markets include callable and portable bonds, convertible bonds, euro bonds, floating rate notes, foreign bonds, index-linked bonds, junk bonds, strips, and etc. Investments based on some underlying assets are known as derivatives. In general, derivatives contracts promise to deliver underlying products at some time in the future or give the right to buy or sell them in the future. Types of derivative instruments are forward contract. A forward contract gives the holder or the obligation to buy or sell a certain underlying instrument at a certain date in the future at a specified price. Futures contracts are forward contracts traded on organized exchanges. A future contract is legally binding commitment to buy or sell a standard quantity or at a price determined in the present, which is the futures price, on a specified future date. A swap is an agreement whereby two parties called counterparties agree to exchange periodic payments. The cash amount of the payments exchanged is based on some predetermined principal amount. An option is a contract in which the option seller grants the option buyer to the right to enter into a transaction with the seller to either buy or sell an underlying asset at a specified price on or before a specified date. A financial market is a market where financial instruments are exchanged or traded. Financial markets provide three major economic functions, which is price discovery, liquidity, and reduction of transaction costs. Price discovery refers to transactions between buyers and sellers of financial instruments in a financial market, determine the price of the traded asset. It is these functions of financial markets that signal how the funds available from those who want to lend or invest funds will be allocated among those needing funds and raise those funds by issuing financial instruments. Liquidity function provides an opportunity for investors to sell a financial instrument since it is referred to as a measure of the ability to sell an asset at its fair market value at any time. Without liquidity, an investor would be forced to hold a financial instrument until conditions arise to sell it, or the issuer is contractually obligated to pay it off. The function of reduction of transaction costs is performed when financial market participants are charged and or bear the costs of trading a financial instrument. In market economies, the economic rationale for the existence of institutions and instruments is related to transaction costs. Thus, the surviving institutions and instruments are those that have the lowest transaction costs. So in the end, it is very crucial for each corporation to have financial instruments because obviously it can gain the corporation's capital. That is all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Alia Sofia binti Muhammad Saluddin. My matrix number is UDE210030. I will answering the question G, which is it better to have financial asset or current asset? So first, I will explain about financial asset definition. Stock, bonds, and cash are examples of financial assets, whereas real assets include real estate, infrastructure, and commodities. Assets are the economy's backbone and lifeblood, allowing us to create wealth. Next, financial assets are highly liquid assets that can be converted to cash quickly. Stocks and bonds are examples of investment. The main characteristic of financial assets is that they have some economic value that can be easily realized. However, it has less intrinsic value on its own. The advantages of financial asset. Some of these highly liquid assets can be used to pay bills or cover financial emergency. This category includes cash and cash equivalents. On the other hand, it may be necessary to wait for the stock to be sold in exchange before it can be settled. Second, when investors have more capital parked in liquid assets, they feel more secure. Third, it performs a significant economic function by financing tangible assets. It becomes possible through the transfer of funds from those who have an access to those who require such financing. And lastly, financial assets distribute risk according to the preferences and risk appetite of the parties involved in the investment of intangible assets. It represents legal claims to future cash, generally at a fixed maturity and interest rate. The agreement's counterparties are the company that will pay the future cash issuer and the investor. These advantages and limitations. Because there are no restriction on withdrawal, financial assets, liquid assets, such as deposits in saving accounts and checking accounts with banks have a very limited return on investment. Furthermore, these assets, such as certificate of deposits and money market accounts, may be restricted from withdrawal for months or years, depending on the terms of the agreement, or they are callable. The contract includes a maturity date. Attempting to cash out assets before maturity results in penalties and lower returns. The important points for the financial assets. The market demand and supplies of such assets determine the value of this asset. These assets are valued based on the cash required to convert them, which is determined by a set of parameters. The value of people's financial asset can change dramatically, especially if they have heavily invested in stocks. A single measurement method cannot be used to assess financial asset. Assume we are measuring stocks when investments are small in size. The market price can be used to determine the value of the stock at that time. However, if a company owns a large number of shares in other companies, the market price of the share is irrelevant because the investor who owns the majority of the shares may not be able to sell them. Lastly, each financial asset comes with its own set of risks and rewards for the buyer. For example, a car company typically has no idea about the sale of its vehicle, so the value of the company's stock may rise or fall. A bond can default if the issuer fails to repay the bond's par value. Even cash and savings accounts are risky because inflation can reduce purchasing power. As for the conclusion, these are an essential component of any organization. It must always keep a good record of its financial assets so that they can be used when needed, such as in a financial emergency. As a result, checking the availability of such asset is beneficial. Every financial asset has a unique but specific goal for the holder. Each is associated with a different level of risk. As a result, returns differ depending on risk for the purchaser of such asset, because each asset type has some reward and risk associated with it. It's always best to keep a mix of different asset types in order to have an optimal portfolio. It contributes to the organization's smooth operation by ensuring that assets are never in short supply. Real assets, on the other hand, are value-driven physical assets that a company owns. They include real estate, buildings, automobiles, and commodities. Its distinguishing feature is that they have intrinsic value on their own and do not rely on exchanges to be valuable. The valuation of real and financial assets is similar in that it is based on their ability to generate cash flow. The distinction is that real assets are less liquid than financial assets because real assets are difficult to trade and lack a competitive and efficient exchange. They are more location dependent, whereas financial assets are more mobile, making them location independent. The advantages are, when compared to financial assets, real assets have the advantage of stability. Inflation, currency, valuation, and macroeconomic factors all have a greater impact on finances than real estate. It has a strong inverse relationship with financial markets. They are unaffected by financial market volatility. It is a profitable investment option for risk diversification that is not related or too dependent on financial markets. In contrast to the capital market, the real asset market is riddled with inefficiency. There is lack of knowledge, which increases the potential of profit. It can be leveraged, which means that real assets can be purchased with debt. And lastly, cash flow from real assets such as land, plants, and real estate projects provides the investor with reliable and consistent income streams. Its advantages are: the transaction costs are high. The transaction costs are lower when we buy shares or stocks. However, the transaction costs are relatively high when purchasing it. Transaction costs can reduce the value of investments, and profit margins may be difficult to achieve. It has limited liquidity. Unlike financial assets, which can be traded in a matter of seconds, these assets are less liquid because land and building capital assets cannot be easily traded without suffering a significant loss in value. Capital gains tax is levied when real estate is sold at a higher price. Short-term capital gains tax applies to properties sold within 3 years of purchase, but long-term capital gains tax applies if sold after 3 years. They also require more maintenance than other types of assets. The investment is illiquid and requires a large sum of capital to be redeemed. To conclude, it provides a consistent and stable income to its investor while maximizing return and diversifying risk, which help to balance investor portfolios because real assets have a negative correlation with other assets. However, it necessitates large capital investment as well as other risks. Back to the original question, which is, which assets are better? Following an examination of these two assets, in my opinion, financial assets outnumber real assets. Because financial assets can be liquidated, this is the case. Real assets such as buildings and land are not easily available for use at any time or place. Real estate cannot be purchased in the absence of financial assets. This demonstrates the power of financial assets because cash always holds the currency and never loses value, in contrast to real assets which must be depreciated annually after purchase. Investors also look at the company's financial assets to see if they are comfortable and confident enough to investing in it. Moreover, financial assets are easily to make fast transactions compared to real assets. That's all from me. Thank you for listening.
So for the last question in this presentation is, can you describe what is contingent asset? A contingent asset is a potential economic benefit that is dependent on some future events, largely out of a company's control. A contingent asset is thus also known as a potential asset. Not knowing for certain whether these gains will materialize or being able to determine their precise economic value means these assets cannot be recorded on the balance sheet. However, they can be reported in the accompanying footnotes of financial statements, provided that certain conditions are met. A company involved in a lawsuit that expects to receive compensation has a contingent asset because the outcome of the case is not yet known and the dollar amount is yet to be determined. Let's say a company has filed a lawsuit against another company for infringing a patent. If there is a decent chance that first company will win the case because it has a contingent asset. This potential asset will generally be disclosed in its financial statement, but not recorded as an asset until the lawsuit is settled. That is all from our group. Thank you.